the Fed raised rates in spite of what was a banking crisis unraveling while it was backstopping these banks essentially. Now, that's very unusual central bank behavior. In years gone by, it's been let's cut rates and provide support. Now, but the Fed's gone and increased rates by 25 basis points. Now, initially leading up to the March FOMC, the chatter was around rates increasing 50 basis points. That didn't happen. Is this a case of the Fed couldn't look spooked? Or is this a case of the Fed is really on their inflation mandate and that's what they're going to stay on course with?
No, look, I'll tell you what this is. This is actually very simple. What this, they are desperate to use the same policies they've used for. I mean, some people will take it all the way back to 87. Some people will take it back to 2000. Some back to 2008. It doesn't matter. But for the longest time, their arsenal has consisted of rate cuts, and then when things get really bad, QE. The one thing that's been absent through that whole period is inflation, and inflation on the other side of that is what keeps central banks honest. It's what disables them from just cutting rates to the floor and being able to get away with it. And they realize that they've clawed, depending which central bank you look at, 3 to 5% back from the abyss. And so the last thing they're going to want to do is give those cuts back in short order. I don't think we're going back to. I don't care how bad the recession is. We're not going back to zero interest rates. I really don't think that is the case, and I think it would be really foolish to give all this back. I think you'll find if we do have a recession, they'll begrudgingly give 25 here and maybe 50 there, but I don't think they'll want to give 50 at any point. And they'll try and maybe give 2% back and hang on for dear life, and then just say to people, look, this is it. This is the floor now. There's going to be some pain, and we have to get through that, because to get back to zero and try and get off your knees again, I think will be the devil's own task. So I think what happened there is that, yes, they have to stay firm. They have to stay credible on fighting inflation, because it's a clear and present danger. And the only way to do that was to go another 25 basis points. If they'd stood still, which was, again, a pretty likely outcome, or God forbid, cut straight away, that would have sent a terrible message, particularly if they cut, and potentially cause a lot more inflationary pressure. So the absence of that inflationary pressure has what's enabled them to do all the things they've done. Now it's there and it's real. It's hamstringing them, and they have to take that into consideration. And that's why I think they're going to be a lot more parsimonious with their rate cuts as we go through kind of the next phase of this rolling crisis.
Quick follow-up question here. Are you on the pivot bandwagon or the no pivot bandwagon? Because there are two very clear camps.
Yes, I am.
There'll be a pivot or no pivot?
Yes, I know. Yes, there will, and yes, there won't be. There won't be. There won't be until they pivot. And this is, again, this is the crucial point of this, right? Because everybody's fixing on one or the other. And look, I am in the camp that they will have to pivot, but it makes a massive difference if they pivot in a month or 8 months. It makes a huge difference to your portfolio and how you trade this and how you invest through this. So, positioning yourself for the pivot because you're absolutely convinced they pivot, and being wrong for 8 months as things get away from you is really dangerous. Assuming they won't pivot and positioning for that and finding out that they pivot tomorrow is equally dangerous. So, this I think is the big danger. And again, it comes back to this dogmatism. The dollar's dead. The dollar will never be replaced. They will pivot. They're never going to pivot. All of these are true. It's just at different points in time. And what the damage that's been done, I think, to investors over the last 15 odd years, this buy the dip mentality is very real, because markets have basically gone up. We haven't seen a sideways market. And, people with as much gray hair as me remember markets that went sideways for a decade plus, it can happen. And so people are positioning themselves as though nothing's really changed. The Fed will ride to the rescue. And when they ride to the rescue, they'll be successful. And when they're successful, that success will look exactly the same. Asset prices will go higher. Inflation will stay low. All the same things are going to happen that have happened every time. And I think that is an incredibly short-sighted and incredibly dangerous viewpoint to take. We are in uncharted waters, certainly for this generation of investors. Say the old scrubs like me have been through similar times before, and even then, this is so long ago that even I was young back when it happened. So my memory of it is a bit hazy, but I suspect I'll get reminded pretty quick. So, nailing yourself to they've always pivoted, so they're going to pivot camp is probably right, because they're going to be forced to pivot. But they're not going to do it like they did at the end of 2018, beginning of 2019, when they buckled immediately. The market fell in December. Remember, we had that kind of shock on Christmas Eve and markets were falling out of bed, and they pivoted straight away. And that's what I think people expect to happen, and that is what I think is not going to happen. So you could be very wrong, and it could be very painful if you get the timing wrong.